Welcome to Zen and the Art of Real Estate Investing, one of the fastest growing real estate investing podcasts in the world. What if you could learn from experienced real estate investors? Find out what got them to where they are now. Get insight into their daily habits and take these insights to inspire your own growth. Each episode, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor and the founder of Streamline, a data-driven, investor-friendly, independent real estate brokerage located in Madison, New Jersey. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, this is the free mentorship program you can take with you anywhere. Now, here's Jonathan.
Thanks for tuning in for another episode of Zen and the Art of Real Estate Investing. Are you interested in truly passive income, making more money, diversifying across multiple asset classes, having more time, gaining liquidity without heavy tax burdens, putting more proceeds to work, compounding for you, and more? If so, this is a great show for you with Brett Swarts of Capital Gains Tax Solutions. We're going all through it soon, and we talk about DST, and in this context, it's not a Delaware statutory trust. It's a Deferred Sales Trust. So this is a little different. Buckle up. Let's go. This is episode 288 of Zen and the Art of Real Estate Investing with my guest, Brett Swarts. Brett is the best-selling author of Building a Capital Gains Tax Exit Plan. I know you know where this is going now. He is the founder of Capital Gains Tax Solutions and a real estate investment advisor. Brett, welcome to the show.
Hey, Jonathan, grateful to be here. Thank you for having me.
Yeah, I'm excited to talk to you, and it's always helpful to give people some tips on what they can do. But let's start with the name of your book. What is a capital gains tax exit plan?
You know, I think it's an intentional way to unlock and multiply your freedom and impact. Most people think it's just tactical. How do I defer tax?
Yeah.
Of course, we defer tax. A 1031 defers tax. So does an IRA. So does a 401k. But does it actually unlock truly passive income? Does it actually unlock you more freedom, more impact? You know, that's really the essence of building a capital gains tax exit plan. It's transformational versus just transactional. And the challenge is most people, the mistake they make is they look just for a transaction. They look for a way to just defer some tax, right? They follow just the general, staple type of deferral strategies, and that's where they find me because they're tired of those old ones. And then we build a capital gains tax exit plan that unlocks truly passive income and ultimately multiplies their freedom and impact.
Yeah, so it would be like a kind of a better snowball than the normal. You just go from one to another. Hey, I have this much. Let me just find a property that's this much that somebody has that I can 1031. That's the problem, right? They're not really making a conscious choice for the long-term plan.
You got it. They don't even know it's possible, right? If you think of the rich dad, poor dad in the fourth quadrant, how do you get to that fourth quadrant where your money works for you and gives you time? Well, you get there by having a massive exit, I've found, right, for Bitcoin business or real estate and converting that into something that gives you truly passive income, 10, 20, 30, 40, 50,000 per month, which truly replaces your living expenses and your lifestyle. Like, that's truly passive income. If you don't have that, then what are you doing? You're probably just chasing that second quadrant on the bottom left or that top quadrant on the bottom of the top right. And so we're looking to speed that up for families and for individuals when they're exiting businesses, real estate, Bitcoin are the main three.
Yeah, I really like it because this is about the mindful approach to real estate investing. And that's a much more mindful technique instead of just saying like, hey, let's just figure it out one to the next. It's setting off on a long-term plan and helping diversify and figure out what's the best road to help your family. Because if people are doing this and they're following a tax exit plan, it's usually because they want to pass along generational wealth, right? We all should if we have children, or we're going to pass it on to somebody or else it's just going to go to the government, which nobody wants.
Yeah, you're spot on. I mean, we believe that truly passive income is to your freedom and impact as compounding interest is to your money.
Yeah.
And once you focus like a laser on that and you get really clear on that number and really clear on how you're going to achieve and unlock that, the big domino falls over when you do unlock that. And the rest of the stuff in your wealth, let's just say your financial world, either becomes irrelevant or becomes less important. But the problem is a lot of the folks before they, real estate investors and folks before they find us, they get diluted focus because they have diluted results. I mean, they get diluted results because they have diluted focus, meaning they're not focused like a laser on achieving this one big, truly passive income outcome, and therefore they get stuck in just the tactical piece of it, and they're wondering why time is just flying by, and they're not at that fourth quadrant.
Yeah, and it does make sense because what you do kind of brings together all of their investments and tries to map out a plan for what's going to work. Whereas just your regular investor, maybe they have an accountant, maybe they have a financial advisor, but then they have their multifamily syndicators and their friends who they flip with. And this isn't a cohesive package of things all going together. And that's where you can eventually lose a lot of money, right?
Yeah, and you lose momentum as well, right? So it's a good point. Our strategy works for Bitcoin businesses, real estate, any asset of any kind you can exit and defer the tax. And the idea is how do you have a tax flow or capital gains tax flow mindset? How do you have a cash flow mindset and a debt flow mindset? And in combining all three, where you can invest as an entrepreneur or be passive and retired and do a mixture of both. And that's really what we build in the capital gains tax exit plan. Every plan should have at least, number one, the time and the asset allocation freedom, right? Meaning you can invest at any time, and you can also invest into any asset at any time. Because guess what? Sometimes it's going to be in mobile home parks or multifamily or real estate debt or Bitcoin or stocks or different things. Now, my preference is real estate, but my preference in the last 3.5 years has been real estate debt, right? Yeah. In fact, we've gotten a lot away from multifamily equity because it's been very challenging. Before that, it was some mobile home parks, some industrial. But I want to be able to mix and buy things on my own timing, and that's where the real estate entrepreneur can make a huge momentum gain when they're buying based upon the intrinsic value and the market conditions, not just buying because a 45-day 180 window with a 1031 exchange.
Yeah. But this is also really a lifestyle assist because it's great to think, like I was saying before, generational wealth. But hey, if you start on this plan early, build a good foundation, now you can actually get some enjoyment out of it by bringing in the passive income to maybe either replace your job or accentuate it so you don't have to work as hard, when you get older like myself.
Spot on. Exactly right.
Yeah, it makes sense. It's just like you get so caught in the minutia and the years seem to move. So like, I can't believe we're recording on August 20th. I don't know how it's even August already in 2025, but it's like, then that becomes year to year. And you look back, you're 65 and you have no plan. Is there a time where it's too late to start this, or can anyone kind of reset it and just get it figured out with the assistance?
I don't think it's ever too late, but I do think it's important that everyone sets what's called perfect life metrics, right? And number two, sets clear family mission, vision, values. This is something I've been working on with a coach of mine named Lloyd Reeb, who's helped me get really clear on what those perfect life metrics are, to get unstuck on things that are holding back from achieving those metrics, and then to get going on that plan. And so having a coach, having someone to look on the outside in, give you feedback. And as far as our strategy, it really comes up when someone's exiting, a massive exit, $1 million plus type of exit with at least $1 million gain. And they are looking for that transition, or that next season of entrepreneurship or the next season of retirement. And they need a team to help execute this, because the reality is none of us are great by ourselves, but we can be great with a team. So having a team, having wisdom is built within teams, right? And so having that kind of board of advisors or that inner circle, especially, or fractional family office, that's what we create when we're building these capital gains tax exit plans. And it helps to bring the wealth in a systemized, intentional way with accountability and encouragement and kind of coaching in as a guide. And that's really what we do here at Capital Gains Tax. We guide people to build these and then to get the momentum moving forward for their next part of their life.
Yeah, it makes a lot of sense because the bigger the gain, the harder it is to just make an easy transition. But for those who are still at the beginning, we still want to tell them, like, if you're starting your snowball early, you can still get to that. You don't know what kind of businesses you're going to build yet, or what you're going to create in real estate, or if you build a snowball that's big enough, but that's what they should be building to, right? They just want to create something that eventually they're going to get we all would like a big exit out of our business or our real estate.
Yeah, I think number one is freeing up your time and your energy. So what is that number? Is it 30, 40,000, 50,000 a month? And get that number down. And then everything else, let's see how you can go make an impact, go make a difference, build your legacy, help people in your community, give to the causes you believe in most. That's ultimately what we're facing here. $100 trillion transfer in the next 5 to 15 years, the largest in the history of the planet. And is it going to be with the government, or is it going to be with the people? And the people being the entrepreneurs, the real estate developers, the investors who can create the housing and end the housing crisis, who can create jobs to help with people with the automation of the world going on with AI. These are real things, and this is the biggest wealth transfer in the history of the planet. So we're on the verge of a tsunami of wealth that can have a tsunami of momentum within jobs, or being stewards with the wealth, or the opposite, a tsunami of disaster with the government wasting it away.
Yeah, I mean, is part of the strategy involve their kind of estate planning as well and trusts that they have, or is that something separate? Because it seems like they go together if you're thinking of that plan, and people need to start early on this.
100% both, right? And so we want to coincide with your living trust. If you don't have one, get a living trust today. Number two, estate tax, and eliminating estate tax is a big piece of this. If you're above $15 million per single person net worth, you have what's called the death tax challenge. So $30 million for a married couple. So we're going to look at these things. We're going to figure out, hey, how do we eliminate estate tax on the exit? How do we defer some capital gains tax? And ultimately, how do we get very efficient with how and where this trust pays you back in a way that keeps you, getting what you need or want for the cash flow, but also efficiently is able to grow and compound by deferring income tax, deferring cap gains tax, and again, eliminating the estate tax. Then you add asset protection into this, and then you also start to see, well, how do we train and coach the next generation? Some of the challenges with entrepreneurs or people that own a bunch of real estate is their time is so focused on running the business that they may not have time to pour into their kids or their grandkids by teaching and coaching them, being an entrepreneur, or partnering with them, right? Some of our clients love to partner with their kids with the trust. This really gives you a dynamic ability to do that. The trust can joint venture partner with you on the next venture. We just did a $5 million exit for a Bitcoin owner. She deferred about $1.85 million of tax. She used a big portion of that to fund the next business venture, startup, all tax deferred. So it's kind of like she 1031 Bitcoin into a business venture, right? Really cool the way we structured it. And then we also did it for a client who sold a $13 million car wash in California. And we diversified into some Bitcoin, into some hotels, into some real estate debt, different investments at different times, just some stocks, and gave him truly passive income. All of these things are really important. And they tend to have this moment in time on a big exit. That's where we set this up before the close of escrow, get everything in line, and work with you and your team to make sure that you keep the momentum post close.
Yeah, I mean, you're talking to someone who probably owned 20 properties before they were 18, because my dad made all sorts of trusts. He was an attorney, as was I. And I mean, these were trusts that he wrote up himself, and, validity wise, but he knew what he was doing. I'm just not sure he did it correctly. But yeah, he was prepping, and everyone always says, when did you own your first property? I'm like, I was a baby. Like, I was just been owning stuff and knew the stuff early on. But that's just part of the process. Like you said, part of it is figuring out how much money somebody needs to live so that you can create the vehicle that will deliver that.
100%.
Yes. So when you're talking about things like you said, you got them diversified into, Bitcoin, some car washes. Where are you and how are you building the relationships with those deals that come along? So somebody comes to you, they say, I need to transfer this amount of money. This is what I'm getting on an exit, and this is what I'd like per month. Is it just based on relationships that you built over the years where you're able to place these deals? Because those seem like also specialized syndications or other options out there.
Yeah, it's a great question. So I grew up in the real estate development business with my family and rental business. And so that's my whole life. I was in California most of my life, mostly in the Bay Area and in Sacramento. Yeah. And so I've been around it since I was a young kid. And then second, went and studied and practiced after I graduated from college, multifamily brokerage at a place called Marcus and Millichap, where I understood the nuances and the details of basically underwriting and cash flow and negotiations. And so that began in 2006. And then in 2009, I learned about this strategy that can eliminate the need for the 1031 exchange. And that's where my acumen started to expand with how to build capital gains tax exit plans using not just a 1031 or Delaware statutory trust, but also what we use as a Deferred Sales Trust. So I would say all of this together collectively helped me to underwrite and see how and where to invest into real estate, whether it be mobile home parks, industrial properties, multifamily, real estate debt. And then you get a sense as you underwrite so many deals and see so many deals, you see patterns and nuances. And then you obviously develop relationships with those who have a track record. And then you see opportunities. Like we bought a property recently, $68,000 per unit, 375 units in Tennessee, probably a B plus property. On basis, that's very difficult to find a $68,000 per unit. Another one, $116,000 per unit. So we bought that about a year ago, and we believe that's pretty close to the bottom of the market. This year is the bottom of the market for multifamily real estate. But we waited a couple of years. But prior to that, we're doing mostly real estate debt, making 10% plus returns on our money.
Yeah.
Right. And so it's not a one size fits all. I think you need to approach it with fresh eyes and fresh underwriting, and building these relationships are key, and track record's key. But I'd also say too is we guide a lot of our clients. They're very smart, sophisticated. We're not the ones saying, hey, I just think you should do this, this, and this. It's more so, hey, here's the stuff I'm looking at. Here are the things I'm planning on investing in.
Yeah.
Why don't you let me introduce you to some groups that are, have a high level of track record, and let's see if it could be a good fit to diversify from your big holding. Like we have a property right now that's set to close here tomorrow for a client. It's a $5 million exit out of like the Monterey, California area. They have massive debt, 40% debt. They'll have about 2.7 or so net into the trust. Well, this is a cool situation, right? We're going to go from about a maybe 3 to 5% ROE, return on equity, and we're going to be able to not only pay off his debt to lower his risk, but to diversify the wealth and increase his return, typically 8, 9, 10%, the way that we structure our strategy. And all of a sudden, he's increased his cash flow. He's decreased his time and energy to spend on the asset. He's paid off his debt. All right, this is transformational for him and his family. Those are the type of plans we love to build, but it's not a one size fits all. But we're inviting our clients to look at the operators in the deals.
Yeah, I think it's important. And based on what you said, the fact that it is not one size fits all makes a big difference. Each one is customized based on their needs, wants, interests, because you can find other things. But also, I really like that you're saying, like we were big on debt when debt was in. But now we're starting to see, look, now multifamily's down. There's opportunity there, because that helps, lend more credibility than just sticking. No, diversification is key. Obviously, anybody in finance knows that of any kind. But I think people get really comfortable with, hey, I'm just good at multifamily. It's like, well, what happens when multifamily goes bad on your end? Right. You need some other options. And to me, I get bored easily. So I love having the opportunity to even own portions of that. Like you said, I don't want to operate a mobile home park, but I'd get in on a syndication, because then I have, I can touch it. I'm involved in it without the management.
You nailed it. So this is the concept that we believe is called diversification of time. And that key part of this is dollar cost averaging, right? And also diversification of assets within a vehicle that allows you to diversify your time. So you want to do both, right? Remember, at 1031 exchange, you're selling one investment property typically, and you're buying another one investment property.
Yeah, I
so
hate
you're
it.
Same asset class, typically in the same market, right? You're trading. I had a client who sold 18 units in Sacramento. His name was Peter. And I said, Peter, why don't you just do a 1031 exchange, right? That's what we always have done. He's like, Brett, I have 18 problems. I don't need 36 problems. He said, what's the point? I go, exactly. This is why we did our strategy, Deferred Sales Trust, and we diversified the wealth, got him out of the challenging properties. And so diversification of time, diversification of dollar cost averaging, diversification of assets is really key here too.
Yeah, and I've always been interested to actually, talk about geographical diversity is interesting also, because then you can diversify across geography. And even if they're the same asset class, you're separating yourself from market cycles in there. One thing I wanted to get to before I go off on another tangent, which is always likely with me because you have so much good stuff to say, just explain the difference between what you guys are doing with your strategy from the traditional 1031 or DST.
Yeah, really simple. And a 1031 exchange is a continuity strategy, meaning you are selling and basically trading or exchanging into another like-kind investment real estate. So the same asset class, you have to do it within 45 days to identify, 180 days to close. So it's a short time period. Yeah, it can be very, very frustrating for those that are wanting to, again, get more flexibility with the timing of the market. We call it the typically sell high, buy higher in the same market strategy, right? By the way, not just, we've done lots of 1031s in the past for clients, and they work so
there's a good plan for them. But like, just as you were saying, the thing that everyone always asks me, like, why did you never do 1031s? It's because I started to do one, and then there were the 3 properties identified, and I hated them all. I'm like, I'm not buying one. Like, I'll just gonna pay the tax. Like,
exactly. So that's the hammer, and you hit the nail, right? And sometimes you hit the nail square on, but sometimes all of the things that happen, we call it a blockbuster, right? You got to return the movie in 3 days. You might have to rewind it. It's just a
the
shotgun.
Kids don't know what we're talking about.
It's a shotgun wedding.
Blockbuster's the best. Yeah.
Yeah. And so what we have we call it the Netflix version, right? So there's no like kind replacement requirement. And you don't have to do any 45-day 180 hair on fire. You can trade a business or for an installment sale, as we'll walk through here in a second. And then you can invest into real estate or real estate debt or mobile home parks or real estate funds or REITs or stocks or Bitcoin. And then you can also exit Bitcoin or stocks or real estate or businesses and go back the other way. And so it's very flexible for how and where you can invest funds. How it works is really simple. You're selling in exchange for a promissory note. And so if you're listening to Jonathan's show any period of time, you probably heard of a seller carryback or a seller, basically carrying the paper, meaning he's becoming the bank for the buyer. So if Jonathan owns a $10 million property in New Jersey, and let's just say he has a zero basis. He's owned it for 27 and a half years, multifamily property, and he's got no basis, no debt, to keep it simple. Well, if he sells tomorrow, he's probably going to pay at least 40% with depreciation recapture, if not more. So he's going to have $6 million versus 10, right? So instead of doing that, we say, Jonathan, first of all, do not overpay for another property. Do not, rent control, all the nonsense that's involved with New Jersey ownership or New York or California. You're just like, do not get caught back in that. Let's instead take the $10 million. Let's put it into Charles Schwab in a trust account, and let's issue a promissory note. We'll make it 9% to keep it simple, okay? And let's go invest the funds based upon your risk tolerance, however you want to invest the funds, and let's see if we can produce $900,000 of passive income, right? And so it's as simple as that. Now, we did have a buyer lined up for $10 million. So the buyer, let's call him George down the street, was going to buy it for $10 million. The trust jumps in right in between Jonathan and the buyer, and basically makes it a three-party transaction. It buys it from Jonathan first for $10 million and turn around and immediately sells it to the George for $10 million. And so at the trust level, there's no gain. Trust bought it for $10 million, sold it for $10 million, so there's no tax. And then at Jonathan's level, he's in an installment sale, right? 100% installment sale with the trust. So he's in a deferral state until he starts receiving payments back from the trust. Now, we can do this all or in part because Jonathan might want $1 million to go buy his primary home or to redo his kitchen or buy a big boat. Cool, Jonathan, we'll do a $9 million note. You pay tax on $1 million, right? Whatever. We can do it a half partial 1031 exchange. He might find a perfect $5 million deal in Jersey that he wants to buy. The other $5 million can go into the trust, so we can accommodate that. But the key here is, what does Jonathan want, and how do we get there? This is the beauty. The buyer takes title the same way they would have, so they're gone. They got everything they bargained for, and Jonathan has a promissory note and/or a mixture of properties based upon his wants and desires.
Yeah, I mean, the flexibility sounds really interesting, especially that you can combine the two. It just gives people a lot of options. Hey, it's Jonathan. I hope you're enjoying this episode with Brett Swarts. And if you're interested in capital gains tax solutions, maybe you're crushing it on a property, but you're ready to unload it because the market is telling you can make a lot of money, but you don't want to pay those cap gains. You want to figure out an alternative strategy. Go to capitalgainstaxsolutions.com. You'll see right up in the left-hand corner, we're talking Deferred Sales Trust. You can email them, you can call them, get in touch with Brett. Let's get back to the show. One thing I'm curious about is, how do you get to these people? One thing I've found with myself and a lot of investors, if you're in it for a long time, pretty healthy ego that you know what you're doing. So you're in this kind of mode where like, well, I mean, what do I need a specialist? I'm making X amount of money. There must be something that you're able to show them how much money they've lost by doing it the way they have or something like that. But is that a barrier? People thinking, hey, I don't really need the help.
Good question. Yeah, I think you want to be humble, hungry, and smart. Anyone you're working with, emotionally smart and humble and hungry to see what's out there. I would say our clients are all of those things. They're open to ideas and they want it. You show them and you break it down on a spreadsheet. You break it down on the investment performance of these different assets. Here's the reality: most of them already know where they want to go with the money. Yeah, right. Yeah. And so they don't really need our help per se to where to place it. Although we're going to have a robust discussion on different options, but ultimately, Jonathan already has places to go. Great, let's do that. And let's find a path to get there in the most tax efficient way. So yeah, that's what I would say. Just, people at the end of the day, people are meeting most of the time, 21 days or 30 days before closing on a YouTube or a podcast, and they're seeing, and then all of a sudden we're quickly getting to know each other, and the stakes are high, and we gotta get to know each other quickly. But the beauty is the funds can hit we work on a conditional basis, so we don't charge anything unless it closes. And if you don't want to use the trust, you don't have to. But our tax attorney, CPA, business partner, thousands of transactions, billions of assets sold, over 30 no change audits. So perfect track record there in the legal part. Our role is the trustee, and so we just guide in the entire process, and then the post close to help execute this. And so once you understand those two pieces and then how the fees work, most people, honestly, they go, oh, great, let me talk to a couple clients. We talked to the couple clients. We're off and running. And the reality is you can have 100% control of 70 or 60% of the proceeds, or you can have indirect control through a promissory note of 100% of the proceeds through our structure. And when they see that, those numbers, it sells itself. And when they see the flexibility for the diversification, it sells itself. And when they see that I'm a trusted advisor to help them accomplish this, man, it's a win-win-win for everybody.
Yeah. And I'm trying to kind of separate from 1031 and figure out why, but it seems like 1031 in the context that we've been talking about is really good when you're still in the beginning stages and you're not trying to transfer a whole chunk, because like you said, you can go from 18 units to 36, and that's just the double the headaches that everybody knows, that, or double the property management fee that you're paying or anything like that. So once you start building it up, then you're going to look for getting more diversified. But it does, not to say that 1031 is a bad thing. I just don't like it because I don't like being locked in to the properties. I feel like there's a lot of people who've kind of bought properties that they maybe wouldn't have bought if they had more time or more options.
Yeah, here's the question you want to ask yourself. Here's the exercise. What matters the most? Not what matters to you, but what matters the most when it comes to your investment real estate or your business you're working or with, or your wealth plan. What matters the most? And I can tell you 99% of the time, Jonathan, I already know the answer. It's truly passive income. Yeah. It's that fourth quadrant where your money is working, you got your time back. You don't have to work for it anymore. It's 10, 20, 30, 40, 50,000 per month. That's what matters the most. And so you ask yourself, well, how do I most quickly get there? Our strategy accelerates that ability to get there. And that's what's transformational for families. They go from thinking, oh, I'm a veterinarian or I'm a dentist and I need to work another 5 or 10 years to get to this EBITDA in order to sell for this price. So after tax, I can use this to invest, and therefore I can live off of it. Our strategy just says, well, why don't you just sell today? Yeah. We'll defer the tax. We just gave you all that time back. But here's the other cool thing. We can defer the income tax on our strategy too for a few years, or you can do partial amounts of it. Mm-hmm. Okay, so you may only need $250,000 per year, not $500,000, at least in the next couple of years. Well, the trust can pay you $250,000, and then 2 years later can increase to $500,000, or vice versa. You might have an earnout. We did a Massachusetts sale for $8 million for a client, $2.5 million of tax was deferred. On that sale, he didn't need anything for a couple of years. So that's cool, right? Yeah. And then he keeps working, and then in a couple of years, he stops working, and then he needs it. So the trust is this very efficient, flexible strategy to turn on and turn off, at least on our 1.0 version. Then we have a 2.0. It's a little less flexible, but it eliminates the estate tax. So if you're above that 30 million married mark, we can eliminate the estate tax without only life insurance gifting or life insurance gifting or charity required. So that's also a nice thing to think about. So understand the problem you're trying to solve, the desire that you want, and then a team to help you get there. That's really the key to unlocking all of this.
Yeah, what role did you growing up in a kind of development family help you as you got along? Marcus and Milchap, everyone I've talked to who've worked in high-end commercial brokers, always helps them. They always get out and they're like, see the big numbers. But what about going all the way back to growing up in that type of family?
Yeah, I think the struggles and the adversity really helped me to grow and to have the hunger to drive and to grow as a leader. So, it was interesting because I grew up in a very successful family at first financially, okay? Mm-hmm. The boats, the Harleys, the Corvettes, the house, the rentals, the properties, all of the wealth. And this is the Bay Area. So this is a very affluent area. Yeah. Well, guess what happened? Parents got divorced, right? The financial aspects were strong, but the other parts of it weren't so strong. The family mission, vision, values weren't as strong. So the divorce happens, and I go from living with mom and dad, having, let's say, a very bright future financially, to being with my mom, we had next to no money. She had health conditions. She couldn't work, and we were 90% of the time with my mom. My dad didn't pay child support. And so we barely could afford a car. We lived with my grandma, who became like my second mom and dad.
Yeah.
And so that piece of it where I'd go see my dad, and my dad taught me a lot of great things: how to be an entrepreneur, how to work extremely hard, how to be innovative and out of the box thinking. My brother and I were the first to graduate college. So we my family didn't really have a real formal, big education background before my brother and I. My mom, unconditional love and belief in her faith that she instilled into us. My point is, I saw both sides of the financial spectrum and wealth, and that helped me to grow and get really clear on what I wanted for my life financially and how I didn't want wealth to separate families. So I would say that's probably the biggest thing. My dad's grit and hard work to work hard and consistently. My mom's, grit to love unconditionally, and knowing that financial, you can use it as a weapon to not pay child support, or you can use it to bless and be, help others.
Yeah. I mean, I had a pretty similar. I mean, my parents got divorced when I was 2. I lived with my mom most of the time. I saw my dad every weekend. My dad was very involved, though. The one thing that my dad did differently was he overpaid child support, made sure my mom had whatever he needed, never really balked about it. And then again, but similar to your dad, when we were in the car, all we're doing is talk about real estate money.
Yeah.
Doesn't matter. Yeah. Like I'm 5 years old. We're talking about stocks. Like, and again, like as I got older, I wonder if this happened with you. I started to realize I know a lot. Like I know a lot about money. I still don't know what the hell I'm doing. But like he gave me a stock account when I was 14 and a Merrill Lynch advisor. And he's just like, if you lose the money, you lose money, but at least try. And I made money. And since then, I've always been good at stocks, I think, because I got the trust. Do you think that was important also? Like you maybe had to earn it a different way. But like when your parents start showing you about money, somebody still has to trust you with money, especially because on your mom's side, you weren't working with a lot there.
100%. So I think there's 2 things on that. So my dad, we would, just actually literally getting in the truck, driving at, 5:30 a.m. to the job site, seeing, looking at the plans, working all day to start to, build the house, see it to completion, see what we could sell it for, going home and looking at the plans again for the next job site. All of just that whole process of building just gets ingrained into you. We would talk about the jobs and completion of them. My dad never had any formal education. So his acumen on like the financial aspects, I would say weren't that high, but his acumen on like getting a job done and getting paid big were big. On my mom's side, she focused on, you and your brother are going to go to college and you're going to get an education, right? And you're going to do all that. We were on like next to, I mean, I'll give you a story, right? When we would drive somewhere, they were very, I'd say more of a scarcity mindset. It was tough because they wouldn't fill up the gas tank until they would leave and then put $5 of cash in the gas tank. And then we would come back. And every time we would leave, it felt like it, at least as a kid, we had to go to the gas station before we go to the final spot. And I'm like, why don't you just fill it up with the $50 of gas? And they're like, we don't have the money. And I'm like, what does that mean? Like, tomorrow we have to put another $5 into that. What's $5 going to, so this whole concept, money was always just having to think about it in that sense. That wasn't I guess blessing and a challenge, right? It wasn't easy, right? Yeah. And so, I think real estate, Marcus and Millichap is when I truly got the multifamily investment education. I mean, I carry my HP 12C everywhere. Yeah. Okay. Yeah. And I do calculations and numbers and running stuff and cash flow analysis everywhere all the time. This is like in my pocket on every podcast. So that was more so when I got to Marcus and Millichap, to be honest. I wish I would have had it with my mom and dad, but they really didn't have that great acumen for that.
Yeah. But it seems like all of that has kind of dovetailed into what you do now, because if you're figuring out how to give people the passive income, again, as we've said, we're talking about the freedom of time. A lot of people talk about financial freedom. That's irrelevant because you want the time freedom, and the time freedom, that part could be different for everyone because what people need to live on is different. So that must be something interesting. There's somebody who may make a ton of money, but they may spend a ton of money. And then you have the savers, like the millionaire next door philosophy, who they're just like stockpiling it. Those must be amazing clients, the ones who stockpiling and aren't just like buying planes and stuff. I mean, if you have $1 billion, get a plane, sure. But
I say 80% of mine are probably more savers and super disciplined. 20% a little less, but I always say it's their money or whatever you want or need, you take it, and we can adjust it along the way. Yeah. So
Yeah, but that makes sense though, because then they're saying like, well, I need X amount. You're like, why? Like maybe to you, it sounds like a lot.
Let's go invest. So let's try to make that. Ideally, yeah, we're cash flowing our trust. We're not dipping it. We actually cash flow our fees too. So we wait about 60 days, and then we cash flow our fees, how we work. So we try to make it as win-win for the client. But it's interesting to be in this side of the business as a trustee. I'd become like family for the clients.
Yeah.
We work together. I'm a trusted advisor. We build dream teams for financial advisors or real estate syndicators or real estate operators. All of this kind of fractional family office approach. And that's honestly transformational for clients as well, because they're so used to doing it themselves. They're at the center of all of the wealth decisions. This helps them to expand that, to delegate a lot of that, and ultimately help them to steward to the next generation. Because if they're the ones always have the answers, then it's tough if something happens to them. So this is a chance for them to help steward and pass that along in an effective way. So I'm working with multi-generational, families to educate. We do live events, we podcast, the book.
Yeah.
It's a mindset, it's a practice, it's a big challenge, and one that we love to be able to serve at.
Yeah, I would think, just based on what you're saying and from my own personal knowledge, it must be so important for the generations to get the information to the next generation. Like I was ready. My dad wouldn't shut up about, like my sister and I knew everything when we were teenagers, but other families, sometimes it's hard. Like my kids are in their 20s. They're interested, but like they don't have a half hour, to listen to me talk about the investments. I'll just make a PDF breakdown. But it must be interesting for you to see like who's involved, because then if somebody does pass away, that goes to the next generation. Obviously, you've set up something nice for them. But a lot of times, what the biggest problem in America and a lot of countries with businesses, the kids don't want to run the business, and they got $1 million business a year going, and they're like, I don't want to do that. Garbage truck sounds terrible, but it makes a lot of money.
100%. Different kids have different passions and different interests, and you're right. I think it's a different level of just attention spans these days, and all of the things. AI is changing the world.
Yeah.
So much there, but yeah, if you could, honestly part of the beauty for our clients is they can set these things up and make them truly passive for themselves while they're alive, but also when they pass, their kids can step into their shoes and they can be truly passive.
Right.
And so, and you can kind of dial in on your living trust how much is the promissory notes are going to pay out for each child. So you can eat, but if you just have all the stuff and you never sell it, the other problem with not doing that and you're just waiting for this stepped up basis kind of idea is that, the spouse may not be able to know how to really exit in a smart way. The kids aren't that interested, and none of it's real set up in an efficient way.
Yeah. And
a lot of the wealth either gets discounted or they don't negotiate well. It's a whole piece of this stewardship aspect that encourages people to exit now, defer, get truly passive, and make it also seamless for the estate plan.
Yeah.
Right. Most people can miss that piece of it. And that's also what we provide. We make it a very seamless transition, and it transforms families' lives.
Yeah. I really just saw it because I was thinking in my head, what I was saying, the kids don't want to be involved. But then I thought, like, when my dad left, when he passed away, like he left us a lot of properties. Fortunately, we were involved with them, so we kind of knew. My sister was really good with the back end. I was good with tenants. But I can see somebody who, maybe they're not as close with their parents, and then parents die and they leave them like 28 separate units across like 5 states. I can't blame them for wanting to sell it. But when you go to sell it, you don't know what you're doing. So you're just like picking random realtors. You probably lose, 20 to 50% on that deal where you could have leveraged it before. So yeah, this is really important.
100%. Anything like this, like 3 years ago, we basically knew the multifamily world was at a peak. I think 80% of the people who were in the inside knew that. But if you didn't sell because of tax or because you didn't have a thing lined up for a 1031, then what's the point? Like the market drops. And then if you were to say pass away within that 3-year period of time, you get a stepped up basis, but you just lost, 15, 20, maybe 30% anyway. Yeah. So the whole, that's really the thing here. It's like, sell what you want to sell for the most important reasons, which maybe is truly passive income, or to get the estate in order when you think it's a good time to sell. Like, get these things involved. And I think that's the piece of this equation is understanding what's going to unlock and what's going to be the bridge to that place of where you want to be from where you're at. And don't wait. Life's too short to wait. Yeah. It's too short to wait. Like go do the things now, sell the assets, sell the Bitcoin, sell the business, sell the real estate, and get truly passive income, and or start that next business venture with this strategy, right? Start that business you want with your grandkids or your kids. Like, don't wait.
Right. Yeah, exactly. I mean, we'll take the same example. The person, if you had gotten rid of the 28 units in the strategy across 5 states, and now you can partner on a business with your kid and something that they want, and you have the leverage to be able to say like, yeah, let's sink this into whatever project you're interested in. You can do that with your kids and your grandkids. That just seems like a much better option, and also very empowering for a generation that's going to struggle to buy homes, is being replaced by AI. I mean, so these things are even more important to set up, my kids, their kids, so that they have more opportunity to create something unique that can't be replaced by AI.
I agree. Don't trade what's profitable for what's priceless, right?
Yeah.
And we have a client, Warren and Catherine. They sold a $2.5 million property in Sacramento, California. Had 2 twin daughters at 10 years old. They were 10 years old at the time. Had them a little bit later in life. Well, the property was pulling a Warren away every weekend for whatever, right? Yeah. And he had good property management, good tenants, but it just kept pulling him away 2, 3, 4, 5 hours of his time. And they were saying, what are we doing here? We're trading what's profitable. It's a good property for what's priceless, the time with our twin daughters.
Yeah.
So we built a plan for them, and we exited. Good news is we exited right before interest rates jumped. We got a record price, diversified their wealth, but most of all, gave them back all of their time with their twin daughters. And they're like, this is amazing, right? For that outcome. And that's really what we want to help people focus on. Don't trade what's profitable for what's priceless.
Yeah. So for you guys at your company, what's the threshold for somebody to get in? Because I want to get through that. And then if they're not reaching that threshold, where should they start so that they eventually can?
Yep, 1 million and 1 million. It says 1 million net proceeds, $1 million gain per transaction. Now, if you had 2 at 500 or 1 at 700, 1 at 400, and you're in Jersey or New York, California, these higher tax states, we can combine 2 to get to that million mark plus. But generally speaking, that's our minimums, okay?
Yeah.
Now, for those that are listening and are like, well, how do I get that? Well, I mean, man, you got to improve the properties, right? You got to increase the rents. I mean, you gotta find a deal that's hard. It's very competitive to get to that $1 million gain plus place. So start a business. I think that answers your question there. So
yeah. The interesting thing that I like about when people, because I like combining businesses, real estate, I love stocks, I like a lot of stuff. To me, buying just a regular mixed use, Main Street mixed use property is a great option to have, because you get a little residential, a little retail. And then if you want to start a business, just start a business in the space that you already own. Are you losing a little on rent? Yeah, but you're giving yourself or your kid the opportunity. So I've been suggesting this a lot, because maybe that's the thing that starts a double snowball. You have a rental property. Now you're starting a business inside of that because you have 2 and 2. Seems like a good way to start that could eventually get there.
100% agree. Yeah.
Yeah. Awesome. For somebody though, who's like at the start of their journey, based on everything that like, what's the best way to get started? Not necessarily financially, but I would say just based on all of what you said, more like with the mindset of thinking for the future. So many people now, I think, are very short-term focused, but what you're presenting is a long-term philosophy. And I think people now, instead of thinking fire, I want to retire early, like what are the steps? Maybe retiring early is great, but what are the steps that are going to help them get there when they're kind of on their way in the journey, but they're just not getting there yet?
Yeah. So Jim Rohn is a great person to help you build this kind of mindset. And he talked about learn to work harder on yourself than you do on your job. If you work hard on your job, you'll make a living. If you work harder on yourself, you'll make a fortune.
Yeah.
And this idea here is personal development, leadership, your faith, your finances, your fitness, all of those areas. When you grow and when the leader gets better, everything gets better, John Maxwell says. So what is your personal development philosophy? What is your personal development goals? What is your personal development plan? John Maxwell says it well. The only guarantee that tomorrow will get better is if you get better. And the only guarantee that you're going to get better tomorrow is if you're growing today. And so what is that? I think too often we focus when I was younger is, getting that degree or getting that basketball scholarship to pay for college, which I was fortunate to be able to do, getting that first career, position at Marcus and Millichap, and then closing that first deal and getting that big check. Those are all external things that, yes, they're important. But what's more important is the internal character development, leadership, faith, growth, all of that. And here's the reality. When you do those things, right, when you become that person, the Bible says, seek first his kingdom and his righteousness, and everything else will be given unto you, right? So for me as a Christian, I seek, I try to, and as a youngster, I did. I remember I got into a men's Bible study that was like a discipleship and encouragement and accountability group, and it helped me grow tremendously when I was about 24, 23 years old, and I was a little bit stagnant, I was like, man, that helped me grow a lot. And so I think, what are the mentors? What are the coaches? What are the groups? Who are you around, and how are you growing in those key areas of faith, fitness, finances, personal development, leadership? So I think that's really the key. You've got to have a plan. You got to be intentional about it. You got to be willing to get in those rooms with those that are going to help you in your journey to become the person you're created to be. And then the rest of it, I think, can happen. I mean, the financial part of it, be strategic, be around those who are making more money than you. I think that'll help a lot.
Yeah.
Be around those that have, done the thing that you want to do in a successful, high level way. Go serve them and go help them get what they want, or, help them make their job or their career or their dream easier. Start a podcast, interview people like Jonathan and me to learn from them, get in that networking, start a YouTube channel. I mean, I can give you probably 100 things, but, what is your plan to start with one is what I would say.
Yeah, I think that's great advice. And I think it's even more appropriate for this burgeoning society of young people, because things like, to me, college isn't going to be that important. You get a degree now, you're not really that much further ahead unless you're really specialized than you were 4 years ago. You would have been further ahead probably if you worked for those 4 years hard at a business. And AI is replacing a lot of stuff, so jobs are going to change. You really have to work on yourself, build up your skill set and whatever you're really good at, because then you're going to be in your zone of genius and then figure out what to do with the money slowly over time. If you have an extra couple grand and you try the stocks in the beginning, it's not a big loss. You just got to practice with money as you go.
I agree. It sounds great.
Yeah. Awesome, man. Is the best place for people to find you and get in touch with you at capitalgainstaxsolutions.com?
Yes. And so if you have a large exit of $1 million net proceeds, $1 million gain, go to capitalgainstaxsolutions.com. Check out the book, Building a Capital Gains Tax Exit Plan, on Amazon. We have Kevin Harrington from Shark Tank in the book, Tony Robbins, CPA in the book too, which is cool.
Yeah.
And it's our story from learning all the things we kind of talked about today. And then second, if you want to follow me on Instagram or all the other things, you have our best 1031 exit plan. You go to brettswarts.com. That gives you access to finding the book, finding the websites, finding the social media links and all that.
Yeah. Awesome, man. Well, it's been a pleasure. Really enjoyed it. I know people got a lot of value out of this, so look forward to staying in touch with you.
Thank you, Jonathan.
All right. That was Brett Swarts. He is from Capital Gains Tax Solutions again, but you can go to brettswarts.com. That seems like the hub site where you can find everything that you need to. I'm Jonathan Green. We'll see you next episode. Thanks for sticking around to the end so you can get a preview of who's coming up on episode 289 of Zen and the Art of Real Estate Investing. And it's John Wells of A Better Way Realty. It's a better way to build wealth and cash flow through smart real estate investing. He's located in Denver. We're talking real estate investing classes, investing opportunities, or buying or selling a home. They've got you covered for all of that, and we take it all in next episode with John.